be May 5th from 1:30 to 3:30. It's the day after the last day of class. It's going to be in the afternoon. For those of you who have the negotiation final in the morning, it'll be in the afternoon. Okay? The official date is May 11th, which is the next week, the Monday of the following week. Okay? I will, as I said, hold at least 10 or 15 seats open on that day, so I'll find a room that at least 10 or 15 seats are available in case you want to take the option at the last moment, okay? Which is actually a very good word to start off today's class with, because today I want to talk about real options. There are actually 3 topics left in this class, and the only substantive one, and I'll explain in a minute why, is real options. So for the next 3 sessions, we're going to talk about applying option pricing in the context of valuation. Before I do that, I want a few show of hands. How many of you are taking futures and options or have taken futures and options while you're here? Okay. How many of you remember nothing about option pricing? I will not, the technology I need is actually fairly basic. These options that we're going to talk about are not difficult options to think about conceptually. Getting the estimates, though, it's not really an option pricing problem. It's going to be a valuation problem. So I'll kind of frame it in that sense. But I'm going to spend the first 35, maybe 40 minutes today kind of laying the option pricing foundations I need. The reason I asked for a show of hands is if you're taking futures and options, what I'm going to say for the next 40 minutes, hopefully, will be easy stuff. You can just coast. Okay? If it's not easy stuff, then I wish you the very best on your futures and options class, because it should be very basic stuff. So I'm going to kind of review everything about option pricing you need to know to apply real options. Okay? So let's step back. Real options are hot. Hot in what sense? In corporate finance, in consulting firms, in equity research houses, people are talking about real options. To show you how hot real options are as a topic. About 10 years ago, I remember when I was writing one of the editions of one of my books, I went looking on Amazon for books on real options, and there were 3. Today, I went on Amazon, typed in real options, I got 65 listings of books on real options. Tells you something about how the topic has kind of exploded in the last 10 years. And I'm a bit of a cynic. When I see something explode in finance, there's usually a commercial reason for it. It's because people think they can use it to make money. And to me, real options are part of this long-term search in finance for what I call the elusive premium. You know what I'm talking about, right? You have a stock that's worth 50. Somebody pays $75 for that stock. They have to explain away the $25 they pay. And you have to use really nice-sounding words to explain it away. 20 years ago, you might have called it diversification. 10 years ago, you might have called it strategic considerations. Today, you call it real options. In other words, real options has become the peg on which you hang every stupid thing you do as a company and get away with it. I'll give you the reason real options are so alluring to companies. You know what real options allow you to do? They allow you to take the discounted cash flow value you came up with. Now, all the time we've spent so far, we come up with the discount and add a premium to it. This is great, right? I'm saying whatever value you get, add 15% to it. I've given you a license to do whatever you want. So I'm going to approach this topic cynically. I'm going to approach it by first looking at where the logic for real options come from, and it's a pretty good logic. And then I'm going to set up a 3-step process for kind of deciphering when it makes sense to talk about real options from when it doesn't make sense. So let's think about where real options come from. To illustrate what drives real options, I'm going to go back to a very simple example. I'm going to show you a decision tree where there's a 50-50 chance of success and failure. You're going to invest money today. A year from now, actually you're investing nothing today. A year from now, if you succeed, you're going to make $100 million. If you fail, you're going to lose $120 million. 50% chance of success, 50% chance of failure. What's the expected value of this tree? Minus 10. You're saying, I would never do this. This is why I went to business school. I can compute probabilities, expected values. Negative expected value, I won't do it. Let me frame that same decision tree slightly differently. It doesn't look like the same decision tree, but here's why I think the 2 decision trees are very similar. This is actually a 2-step decision tree. The first stage, you have a 1/3 chance of success and a 2/3 chance of failure. If you fail, you lose $20 million. If you succeed, you make $20 million. If you succeed, you're going to follow up with a second stage investment. There's a 2/3 chance of success and you make $80 million. And you have a 1/3 chance of failure, you lose $100 million. What's a cumulative probability of success in this two-stage decision tree? 1/3 times 2/3 is half. 2/3 times 1/3 is half. There's a 50% chance of success, a 50% chance of failure across both branches. The total amount you're going to make if you win is 20 plus 80, which is 100. The total amount you're going to lose is 120. That's exactly identical to what I showed you in the previous decision tree, right? 50% chance of success, 50% chance of failure, 100 upside, 120 downside. But here's the magic. If you compute the expected value of this decision tree, the expected value is positive. How did that happen? What is happening in this second decision tree that's making a decision that looked like a bad investment in the previous decision tree become a good investment here? As an investor, what is it about the second decision tree you like better than the first one, which is creating a positive expected value? Yep.
The option to stop it was pricing.
Let's not use the word option actually for the moment, right? First is you have that first stage, right? At the first stage, either a good thing can happen or a bad thing can happen. If the bad thing happens, what do? You say, you know what, I'm not trying this again. This is probably going to be a bad project. There are two key ingredients behind the real options argument. The first is learning. You're learning from what's going on. The second is you adapt your behavior based on what you're learning. Do you see where the adaptive behavior is here? You observe what happens in the first branch. If it's a success, you follow up by investing more. If it's a failure, you stop. Learning and adaptive behavior. That is at the core of the real options argument. Let me give you a preview as to how learning and adaptive behavior can affect the value of a business. Let's say you're valuing an oil company. What's a standard process we use in a discounted cash flow model? We project out the number of barrels of oil you'll produce each year. You multiply it by an expected oil price. You come up with revenue, subtract out expenses, come up with a cash flow, which you discount back to the present, right? That's a standard discounted cash flow valuation. You might be doing the world's best job in estimating oil prices and oil production, but here's what you're missing. If you actually ran an oil company, the production of oil, the amount of oil you produce, is not preset, right? You get to observe the oil price before you decide how much to produce. So there's the learning. You look at the oil price, you learn from it, you adapt your behavior in the sense of adjusting how much you produce. When oil price is $100 a barrel, you try to produce more, sell more. When oil prices drop to $15 a barrel, you cut back on production, you stop exploration, you produce less. Which basically means if you carry this to the next step, what I'm saying is if you use a discounted cash flow model to value an oil company, you're going to understate the value of the oil company because you're missing the option component. The managers in this company can adjust the way they run the company based on what oil prices do. So that's really the core of the real options argument. So the argument itself makes sense, but I think it's applied in a lot of places it shouldn't be applied. So here's a three-step process we're going to use to decide when it makes sense to apply options and when it doesn't. We're going to start out with a basic question. When should we even be talking about options? What is an option? How do we recognize that there's an option in an asset and start pulling out our option pricing tools? Second step. When does that option have significant economic value? In other words, when should we even be wasting our time applying models to come up with the value of the option? When does an option have significant economic value? Final question, assuming there's an option that has significant economic value, when can I use option pricing models to actually value the option? Here's what I'm going to argue. There are lots of options out there. When I describe to you what an option looks like, you're going to say, there's an option, there's another one, there's another one. There are hundreds of options out there. When we ask the second question, when does an option have significant economic value, you lose about 95% of the options. And the test we're going to use there, to me, is the key step in real options. It's at that stage where you separate the fakes from the real options. So we'll talk about when there's significant economic value. Now, out of the 5 cases where there is significant economic value, you're going to find very quickly that the technology we've developed for option pricing doesn't travel very well to many of those real option examples, and we'll see why. Okay? So let's start with the first question. When should we even be talking about an option? Looking at it from the outside, there are 3 things that I think make options options. First, options are derivative securities. There has to be an underlying asset from which you derive your value. Options are like leeches. They can't live by themselves. You need something to live off, so there has to be an underlying asset. Second, options always have contingent payoffs. Something has to happen for your option to pay off, right? In a traditional option, the stock price has to rise above the strike price if it's a call option, but there's got to be a contingent payoff. Third, options have finite lives. You can't have a perpetual option. You have a 5-year, 8-year, 10-year option, so options have finite lives. So underlying asset, contingent payoff, finite life. Anytime you see those three things come into play, you've got an option. In fact, the best way to recognize an option is to draw a payoff diagram, right? Take an asset, draw what your cash flows will be, and if the payoff diagram looks remotely like this, you've got to talk about options. Whether you call it an option or not, there is an option embedded in an asset. Options have that unique payoff diagram where you have limited losses and potentially unlimited profits. So that is at the core of recognizing an option. When you draw the payoff diagram for an asset, it looks like this, you got a call option. If it looks like this, you got a put option. So perhaps the first step in recognizing options is to draw that diagram. We're going to go through several examples of real options. Every single one, I'm going to always start off with a payoff diagram to back up why I think it's an option. Because once you've got the payoff diagram, the rest is pure mechanics. So that's the first step. When is there an option? You can already see there are lots of assets which have payoff diagrams like these. And if you have a payoff diagram like this, you have an option in your hand. Here, to me, is the key step at which you start losing real options. When does this option have significant economic value? I'm going to give you a word which to me is the key, is a word that we should always be using in the context of real options to debate. Exclusivity. Options have value when you have exclusivity. You know what I mean by exclusivity? You and only you can exercise this option. You're saying that's pretty obvious. That's always true for an option. For listed options, it might be true. But for many real options, it's very difficult to establish exclusivity. I'll give you a very simplistic example to kind of back up what I mean by exclusivity. It must have been 7, 8 years ago. End of one of these MBA classes, people are graduating. Second year MBA comes into my office, week left to graduation. And he's very excited. He's excited because his landlord has given him the right or the option to buy the apartment he's renting any time over the next year. So he walks into my office and says, I want to use Black-Scholes to value the option. I say, aren't you getting a little carried away here? He says, I've spent a lot of money on this MBA. Damned if I'm going to let it go to waste. I want to apply it. So I said, okay. Tell me something about what your landlord said. He said, my landlord gave me the right to buy the apartment I'm living in for the next year. So I said, what price? Thinks about it for a moment. He says, you know what? He never mentioned the price. I said, let me frame this for you differently. Basically, what you have is the right to buy the apartment you're renting right now, anytime over the next year, for the prevailing market price. Is that right? He thought about it for a moment and said, well, I guess that's what I have. And I said, what do you think it's worth? What's the right to buy an apartment at a prevailing market price worth? Where's the exclusivity? The guy on the street could do exactly the same thing, right? That is not an option. In fact, the paper I have on my website on real options says opportunities are not options. There's too much mistaking of the two. Hey, we're going to talk about companies expanding into China. If you ask them why they're doing it, in the face of losses, there's an option there. Easy to use the word, but you might be talking about opportunities, they're not options. So the key word here is exclusivity. If you are the only person who can exercise an option, clearly the option value accrues to you. But if you do not have exclusivity, it's not a 0-1 proposition, full exclusivity, no exclusivity. The less exclusivity you have, the less value the option is going to have. So with every real option, we're going to stop and ask a question. With this real option, where's the exclusivity? Where does that exclusivity come from, and how long can it be sustained? Once you've decided that there is an option, the option has significant economic value, then we know what the variables are that drive the value of that option, right? We've known for 35 years, since Black-Scholes came out of that model. There are only 6 variables that determine the value of an option. 3 of them relate to the underlying asset. The first, of course, is the value of the underlying asset goes up and down. The value of your option will go up and down as well. If it's a call option, it will rise with the value of the asset. If it's a put option, it will go in the other direction. The second variable that drives the value of an option is uncertainty about the value of the underlying asset. And here's where real options turn everything we've said about risk so far on its head. Unlike every other valuation approach, where as you increase risk, value goes down, with options, as you increase risk, value goes up. And we talked about this early in this class. The reason that happens is very simply because of that payoff diagram, right? Go back and look at the payoff diagram. What's unique about an option pricing payoff diagram is you have limited losses, unlimited profits. The reason we worry about risk is not because of upside risk, but downside risk. And with options, I've given you protection against downside risk. So the more volatile, the higher the risk, the higher the variance, the value of the underlying asset, the more valuable all options become, calls as well as puts. This is not a bet about direction. It's a bet about volatility. And the third variable relating to the underlying asset that affects all options is if you expect the underlying asset to pay any dividends over the life of the option, it will affect the value of your option. Do you see why? Let's take a simple example. You have a call option on a stock that pays a big dividend. You know it pays a big dividend. In fact, the stock price right now is 50. Tomorrow is an ex-dividend day, and you know there's a $2 dividend coming tomorrow. What's going to happen to your stock price tomorrow? It's going to drop by roughly $2. Otherwise, you'll have arbitrage, right? If you have a call option on the stock, think of what that does to your call option, right? A call option gives you the right to buy the stock at a fixed price. If you expect a dividend down the road, it's going to lower the value of the stock price. You've got to build that into the value of the call option today. The higher the expected dividends on an asset, the less valuable call options will become, the more valuable put options will become. So you value the underlying asset, variance in that value, dividends on the asset. There are two variables relating to the option itself. One is, of course, the strike price of the option. The right to buy something at a fixed price is worth more if that price is lower rather than if it's higher. The right to buy an apartment at $100,000 is worth more than the right to buy the same apartment at $150,000. So it'll vary with the strike price. The other variable relating to the option is the life of the option. You'd much rather get this right for 5 years than 2. 2 years rather than 6 months. The longer the life of the option, the more valuable all options become. So you've got the 3 variables relating to the underlying asset, 2 relating to the option. The only macro variable that affects option prices is the level of interest rates. And here's the reason it affects option prices. When you get the right to buy something at a fixed price 2 years from now, what you have to worry about is the present value of that price today, right? As interest rates go up, for any given price, the present value of that price becomes lower. So the agreement you have to pay $200,000 2 years from now, that $200,000 is worth less today if interest rates are 15% than if they're 5%. Which means as interest rates go up, call options will become more valuable because you pay in the future, and put options will become less valuable. That's it. There's no growth, no cost of capital, nothing to worry about, partly because you're deriving your value from the underlying asset. Those are all embedded in the underlying asset. So when is there an option? Once there is an option, it is a significant economic value. We know what the 6 variables are. Which brings us to the third question. When can I use an option pricing model to value an option? You know, I noticed a few hands go up, and I said, how many of you don't remember anything about option pricing? Even if you don't remember anything about the mechanics of option pricing, here are the 2 foundations on which every option pricing model is based. The first is replication. You know what replication is, right? I mean, this is essentially the insight that Fisher, Black, and Marin-Scholz brought to the option pricing model. Until 1971, if I asked you to value an option, you valued it exactly the same way we valued any other asset. You took the cash flows, you took the probabilities, you took an expected value, you discounted that all back, and you treated it like any other asset. What Fisher, Black, and Marin-Scholz said is, hey, this is silly. You have an option. It is a derivative asset. You can create something that looks exactly like the option in terms of cash flows by combining the underlying asset and either borrowing or lending. That's what replication is. You give me a call option, I can create something exactly like that. And that's what every option pricing model tries to do, is comes up with that replicating portfolio, a portfolio that has exactly the same cash flows as the option. So the first foundation on which option pricing models are built on is replication. Once you've created that replicating portfolio in the option, they have exactly the same cash flows, right? Here's a second foundation for all option pricing models. It's arbitrage. Arbitrage in what sense? If you have 2 investments with the same cash flows, All that arbitrage is saying is, hey, they have to sell for the same price, because if they did not sell for the same price, you'd buy the cheaper one, sell the more expensive one, lock in the profit, and because they have the same cash flows, you have no risk. Replication and arbitrage are the two foundations on which option pricing models are built. Now, if you look at the actual Black-Scholes model, you don't see the replication there, right? It says S times ND1 minus KE minus RT ND2. In fact, a better way to think about replication, I don't know whether any of you did this in foundations or any of your classes, is to think about it in terms of the binomial model. In a minute, I'll show you the binomial model, but essentially what you're trying to do in these models is try to come up with a combination of the underlying asset and borrowing, if you're replicating a call, or the combination of the underlying asset and lending, if you're replicating a put. So every option pricing model, that's really the device you're using to come up with a model. So in fact, let me show you in a binomial model exactly how the replication works, because once you see that, then you can start transferring it to a Black-Scholes model. You know what a binomial model is, right? Basically, at every stage, you can go to one of 2 points. I'm going to give you a stock that right now trades at $50. Next period, it can either jump to 70 or drop to 35. So it's a pretty restrictive model, only 2 points at each stage. If it goes to 70, then it can either jump to 100 or drop to 50. Goes to 35, it can go to 50 or 25. So right now you're standing here. This is where you could end up at t equal to 2. I come to you with a call option with a strike price of 40, expiring at t equal to 2, and tell you the riskless rate is 11%. So I want you to price that option. So that's your task. You know where you are right now. The stock is 50. You have a call option with a strike price of 40. What's the minimum price that the call option has to trade at right now? It has to trade at least 10, right? Do you see why? Because the stock price is 50 right now. The strike price is 40. You should be able to make 10. So you know the minimum price, but that's kind of a very low ball estimate of the value. That's the exercise value of the option. Here's how I'm going to try to value the option. I'm going to start with the end nodes first. You know why I start with the end nodes? That's the only point in time where I know exactly what the cash flow on the option is going to be. So if the stock goes to 100 and I have this call option with a strike price of 40, I'm going to make $60 because I'll buy at 40, turn around and sell at 100. If the stock goes to 50, I'll make $10, 50 minus 40. If the stock goes to 25, I'll lose $15. No, right? Why don't I lose $15? Because an option is a right, not an obligation, right? That's what makes option contracts different from futures contracts. If the stock price goes to 25, you're going to take the option, put it in the trash can, and say, I wish I hadn't done that. But you're not going to exercise. So you have 0. So 60, 10, 0, those are the cash flows that I'm going to have at the call at t equal to 2. My task is laid out for me, right? I want to combine the underlying stock and borrowing, and that replicating portfolio has to have cash flows of 60, 10, and 0 as well at t equal to 2. That's what I'm going to try to accomplish. So here's what I do as a first step. I start with this end note, $70. I said, let's assume I'm at a stock price of 70. I know the stock is going to go to either 100 or 50 in the next period. I want to combine buying the underlying stock, let's call it delta shares of the underlying stock, and borrowing money, and let's call that B. We don't know what they are right now. I want to create this portfolio of delta shares and B in borrowing, and that portfolio has to have a value of 60 if the stock goes to 100, and a value of 10 if the stock goes to 50. So I set up the equation. If I buy delta shares of stock, if the stock goes to 100, I get 100 times delta. I have to pay off the borrowing with 11% interest rate, so I'm paying off the borrowing. And the difference has to be equal to 60. So 100 times delta minus the borrowing with the interest is going to give me 60. If the stock goes to 50, 50 times delta minus 1.11b has to be equal to 10. Now do you see why it has to be a binomial model? How many unknowns do you have? 2. This is high school algebra, right? You have 2 unknowns. You better have just 2 equations. If I had a trinomial model, you know what's going to happen, right? I'll have 3 equations, 2 unknowns, and there will be no unique solution. This is not magic that we're pulling out here. The reason we have this restrictive binomial model is we have 2 unknowns, 2 equations, and if you have 2 unknowns and 2 equations, you work at it long enough, hard enough, there should be no unknowns at the end of the process, right? You just go through the standard process. In fact, that's all I did. I took the 2 equations, solved for delta and B. And at the stock price is 70, the answers I get is delta is 1, B is $36.04. You're saying, what the heck does that mean? The stock goes to 70. I go out and borrow $36.04 and buy 1 share of stock, I will create a portfolio that has exactly the same value as my call if the stock goes to 100 or 50. I've created my replicating portfolio. Now think like an investor. How much of your money would you have to come up with to create this position? 1 share of stock is going to cost you $70, right? You borrowed $36.04, which means you got to come up with $33.96. That's what it costs you to create the replicating portfolio. So the call option is to trade at that price if the stock is 70. That's it. That's replication. It's algebra and simultaneous equations. You solve for the unknowns. You got how much you need to borrow, how much you need to buy. Let's repeat the process at 50. I'm not at 35. I won't go through the full details, but you're doing the same thing. You're saying, I know the stock is 35. It can go to 50 or 25. If it goes to 50, the call is worth 10. If it goes to 25, the call is worth nothing. Let me solve. If you solve that simultaneous equation, if the stock goes to 35, delta is 0.4, B is $9.01. You're saying, what does that mean? If the stock goes to 35, here's what my replicating portfolio will require me to do. I have to borrow $9.01 and buy 4/10 of a share. Don't even ask me how I buy 4/10 of a share, but I have to buy 4/10 of a share, which costs me $4.99. So you know what I've solved for right now? I can now give you the value of the call if the stock goes to 70, it's $33.96, and the value of the call if the stock goes to 35. So now I can move back all the way to today. I go back to today and I set up the same process. How much do I need to buy of the share? How much do I need to borrow to end up with $33.96 if the stock goes to 70 and $4.99 if the stock goes to 35? Now do you see why I have to start at the last node and work backwards? It always has to be the end node working back once. You can't jump steps because you need the numbers you get in the last step to get the second to last until you get to time equal to 0. And if you solve the equation today, here's my ultimate replicating portfolio. Today, the stock is at 50. If I go out and borrow $21.61, buy 0.8278 shares of stock, I have created a self-financing replicating portfolio. Self-financing in what sense? If the stock goes to 70, that portfolio is going to be worth $33.96, right? That $33.96 is enough for me to create the replicating portfolio I need if the stock goes to 70. Stock goes to 35, the portfolio is going to be worth $4.99. Self-financing again. I've essentially created something that looks exactly like the call option all the way through its life. So binomial models are actually great to see replication kind of play out in front of you. But binomial models are restrictive, right? Because at every stage you can jump to only one of 2 points. To have even the remotest chance that your stock will actually follow a binomial model, you got to make the time periods really short. Because if you made time 1 day, think of all the conceivable prices you could have at the end of the day, right? You got to make time maybe 1 minute. So let's say you have a 3-month call option. You decide to use the binomial model. You decide to slice time up into 1-minute intervals. And you decide to draw a binomial tree. Can you visualize what that tree is going to look like? Close your eyes. Don't go to sleep. Think about it. Little branches along the way. I don't even know how many, but you'll have tens of thousands of branches kind of in this tree. Even in theory, if you could do it, it's going to be this incredibly dense tree. Stay with me. So you now have this binomial tree with tiny little branches, right? Flip the tree over on its base. So it's going like this now. Flipped it on it. What does it look like? It looks like a pine tree without a trunk, right? Now smooth the edges of the tree. What does it start to look like? You're starting to look like a normal distribution. If as you make time smaller, the price changes also become smaller, the binomial distribution converges on the normal distribution. That's a smoothing out of the tree. And the binomial model becomes the Black-Scholes. The Black-Scholes and the binomial are not competing models. The Black-Scholes is a special case of the binomial model when price changes. What I mean by price changes are small is the way prices move from $30 to $60 in this world is they go $30, $30.02, 34. They don't jump. Is that realistic? Do prices actually jump in the real world? Absolutely. The Black-Scholes model is built on a premise that's unrealistic, but by doing it, they get this great bonus. You can work with a normal distribution, and a normal distribution is the easiest of all statistical distributions to work with because you can capture it with the expected value and the standard deviation. So as t gets smaller, price changes also get smaller. The binomial distribution becomes a normal distribution. The binomial model becomes the Black-Scholes. Now, just to kind of expose you to something that's almost never done, if you accept the premise that even if as t gets really small, prices can continue to jump, then the converging distribution is no longer the normal distribution. It's going to be some kind of jump process distribution. For those of you who've done enough statistics, you know the choices, right? The Poisson distribution. Usually the way this is presented in a statistics class is as a bank teller. There's a line in front of you. They'll give you an expected value in the expected number of minutes that the teller spent. You join the line. How long will it take you to get to the front? The answer is you never get to the front of the line, but they don't want to hear that. They want you to work out numbers at 37 minutes. That's a classic Poisson distribution. People arrive in the line at irregular intervals. You can have big bunches coming in at times. You're saying, how come we don't have option pricing models built on a Poisson distribution or a jump process distribution, given that it's more realistic? There have actually been models that have been built. There's a model that Bob Merton won the Nobel Prize, built in the mid-70s, built on a Poisson distribution for pricing options. It never caught on for the following reason. You need about 5 parameters to characterize a Poisson distribution, instead of the 2 that we have in a normal distribution. And the parameters are very difficult to estimate. So people who try the option pricing model with jump processes very quickly give up because the inputs are so difficult to come up with that the cost of being realistic is you actually end up with a less precise value. But the Black-Scholes model is built on that continuous price distribution. You can already see the bias that this is going to create in the model, right? Because prices can't jump in the Black-Scholes world, what kind of options is the model most likely to undervalue? At the money options, deep in the money options, or deep out of the money options? You see my question? You're using the Black-Scholes to value listed options. I gave you the assumption. Black-Scholes is built on the assumption that prices don't jump. What type of options do you think it's going to underestimate the value on? The deep out of the money options in a Black-Scholes world are going to be assigned too low value. You see why? Stock is at 50. Okay? The strike price is 80. In the Black-Scholes, we're getting from 50 to 80 is this huge task because you have to go 50, 50.01, 50.02, 50.03. But in a world where there are jump processes, you can see that getting from 50 to 80 might be a low probability event, but it's not that low a probability. Which means if you're using Black-Scholes models for deep out of the money options, you will tend to underestimate the value. But we know at least the direction of the bias and why it's happening. So as time gets shorter, you get to the continuous price distribution, the binomial becomes a Black-Scholes. So let me show you the Black-Scholes model, probably the most seen model in most finance classes. It's a one model where almost all the inputs are observable, so you feel pretty comfortable using the model. This is the classic Black-Scholes model, and in the classic Black-Scholes model, there are 5 variables that determine the value of an option. The value of the underlying asset, S, the strike price on the option, K, the life of the option, T, the riskless rate corresponding to the life of the option to capture the level of interest rates, and the variance in the log of the value of the underlying asset. This is a theme you notice constantly in estimating variances for the Black-Scholes. It's always supposed to be the variance in the log of the price. Why is that? What's this fixation with logs? Basically, we said the Black-Scholes is built on a normal distribution, right? We know prices cannot be normally distributed. Why not? A normal distribution goes from minus infinity to plus infinity. Price cannot be less than 0. What's the log of 0? Minus infinity. You know what you're doing is you're hoping and praying that if you take the logs, there's no guarantee that even if you do this, it's going to be normal. By using the logs, at least you have a shot of getting a normal distribution out of this, and you're saying, please God, let me get close. So there are 5 variables in the Black-Scholes. But I thought there were 6. What's the missing variable? So we have the value of the underlying asset, the variance in the value, but we're missing dividends, right? How come? The original Black-Scholes did not have dividends in it. You know the reason for that? The mathematics of solving for the Black-Scholes got so messy. In fact, the legend is that Black and Scholes basically wrote out the equation for the model and didn't know how to solve for it because nobody in finance had ever seen anything like this before. because it needed something called stochastic calculus, which nobody in finance had ever seen. Even calculus was kind of a foreign language in finance, and stochastic calculus, nobody even knew about. The legend is some physics PhD student at the University of Chicago, which is where they're taught, wandered in their office one day, looked at the equation, and said, oh, we see this in first year physics all the time, and wrote it out. He said, it's called Ito's lemma, and we do use this in physics. It's very simple. And he wrote. So the Nobel Prize should really have gone to Fisher Black, Myron Scholes, and an unknown PhD student in physics. But they were so stuck in this that they said, we can't even deal with dividends. So let's make dividends go away. So you know how they made them go away? They essentially assumed that the options they were valuing were dividend protected. You say, what the heck is a dividend protected option? Remember the example I gave you, $50 stock price, there's a $2 dividend, the stock price is likely to drop to 48. If you had a dividend protected option, your strike price would also be lowered by $2 if there's a $2 dividend. In other words, I protect you against the stock price drop by adjusting the strike price. There are no options in the real world that are dividend protected. So this was just an exercise they went through to get rid of dividends from their equation. Clearly, we've got to bring dividends back. We can't just value options on stocks with no dividends or assets with no dividends. But the original Black-Scholes, the final version of the model, you see, value of the stock today, N of D1. That's actually an area under the normal distribution. The reason I emphasize that is you open up any statistics book, there's a normal distribution in the back, right? That gives you the height of the distribution. So basically, it's the height of the distribution at each stage. That's not the distribution you want. You want an area in the distribution. Basically, you're saying what's to the left of whatever number I'm looking at. And if you look at the normal distribution, it's a standardized normal distribution. N of D1 is a number that lies between 0 and 1. It's like a probability. In fact, the best way to think of N of D1 and N of D2 in an option pricing model is think of them as probabilities. In fact, N of D2 has a very specific probability reading. It's the risk-neutral probability. Ignore the word risk-neutral if you don't want to deal with it. Okay? It's the risk-neutral probability that your option will end up in the money sometime over the life of the option. Let me repeat that again. When you see N of D2 in a Black-Scholes model, you're estimating the probability that your option will end up in the money sometime over the life of the option. So when I say N of D2 is 0.7, I'm saying there's a 70% chance sometime over this option slot that this option will end up in the money. So you got N of D1 and N of D2, both numbers coming off the distribution. S is the stock price today, K is the strike price. What's E minus RT? Let's face it, the Black-Scholes model makes you touch all those virgin buttons in your calculator, right? Buttons that were never touched. You got them, the log button, the exponential. They just sat there for a year and a half. Please use me, but he said PV, 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 payment, PV, payment, PV. You basically use through those. Those buttons are worn through. Black-Scholes says, hey, come on, you can use those other buttons too. What's E minus RT? I'm sorry?
Continuous compounding.
It's a present value factor. First, let's see why there's a present value factor. The Black-Scholes model is designed to value European options, which is actually a very unfortunate term because it suggests something about geography. It's nothing to do with geography, right? What's the distinction between a European option and an American option? American options can be exercised anytime. European options can be exercised only at maturity. So when you value a call option, you have to pay the strike price at maturity, 2 years from now. So you don't have to pay it today. So all we need is a present value, the strike price. But you say, this isn't the way we compute present value. We take K and we take 1 plus R raised to the power of T. But because we're working with continuous time, that's just the present value factor. In fact, if you don't have an exponential button on your calculator, just do a traditional present value. You get pretty much the same answer, especially with longer term options. But that's the present value of the strike price. Embedded in this equation is the replicating portfolio. The D1 and D2 numbers actually come from all those variables, S, K, R, T. They all go into D1. It's like magic. They feed in there. So what you did in the binomial over multiple periods, the Black-Scholes is doing in one step through the normal distribution. But here's the replicating portfolio that's embedded in the Black-Scholes. Remember the replicating portfolio, you're going to buy delta shares of stock and B that we solve for explicitly in the binomial model. It's in the Black-Scholes as well. One of the biggest problems with people using the Black-Scholes is they use the model, they come up with a value, they throw the model out. The real information is not in the final number, it's in all the intervening numbers. And here's the replicating portfolio for this call. You go out and you buy N of D1 shares of stock. That's like the delta in your binomial model. That's half of your replicating portfolio. You borrow KE minus RT, the present value of the strike price times ND2, that becomes a borrowing. That's your replicating portfolio. Everything you see in the context of option trading is built around the replicating portfolio. And option traders love Greek, right? Option delta, theta, gamma. I mean, pretty much they've taken over the entire Greek language. Everything they're talking about is embedded in there. The option delta is the number of shares of stock you need to buy to replicate the call. What's the option gamma? When the stock price changes, as it will from today to tomorrow, the option delta will change, right? The option gamma will tell you how much the delta changes as the stock price is. Why would I care? You have a hedging position. You better care because tomorrow the stock price changes. You can't sit with the original hedge. You got to adjust the hedge. So that's your option gamma. What's the option theta? This is a 2-month option. Tomorrow will be a 1-month, 29-day option. Day after, even if nothing else changes, the delta is going to change as T changes. That's the option theta. What's the option vega? I told you they took over the entire language. The standard deviation of the stock changes from today to tomorrow. Your replicating position is going to change. Everything is built around that replicating position, both from a practical pricing standpoint and from a hedging standpoint, because you need to know what that replicating portfolio will look like. But they're all built on the premise of continuous price movement. So whatever screw-ups you have in the model are going to feed into your hedging portfolio. Okay? So that's the basic option pricing technology. Okay? Let me actually complete the story, because obviously we have to deal with dividends. There's a version of the Black-Scholes that's been developed since the original Black-Scholes that brings in dividends. And here's the adjustment that's usually made. It's actually a very simple adjustment. What worries you about dividends? That when those dividends get paid, they're going to lower your stock price, right? Here's the simplest way to adjust for dividends. Let's suppose I told you that your stock has a 2% dividend yield for the next 10 years. So roughly speaking, every year for the next 10 years, you're going to lose 2% on your stock price because those dividends get paid, right? So what this adapted version does is it takes the stock price today, adjusts it for the expected price drop from dividends by bringing in the dividend yield. So think of that as the adjusted stock price lowered to reflect expected future dividends. So that's the first adjustment. The second adjustment happens within the model for D1. The riskless rate is the price you pay for creating the replica, because you have to borrow money, you have to pay the riskless rate. But you buy delta shares of the stock, right? That stock now pays a dividend. So you know what you're going to do? You're going to take the dividends and cover some of your riskless rate. So what you see inside the model is a difference. It's like a carrying cost. You might see these in futures and forwards. It's a difference between the riskless rate and the dividend yield, reflecting the cost to you of carrying that replicating portfolio. You make those two changes, you pretty much have a Black-Scholes model for a dividend-paying stock. So you can already see that the choices here are pretty straightforward. You can go with the binomial, you can go with the Black-Scholes. Once you've got those variables, the S, K, R, you still have to come up with those. In fact, as we go through the real options, here's what I'm going to do. I'm going to establish as an option. Then I'm going to talk about how do I come up with S, K, R, because once you can come up with the inputs in the option pricing model, then you can feed them in. But here's the thing that I think you need to be cautious about. It's built on replication, right? Every one of these models. In order to replicate a call, you've got to be able to buy and sell the underlying asset. You've got to be able to buy and sell the option. So what's the big deal? On a listed option, on a listed stock, not a big deal, right? You can trade IBM, you can trade the option. One of the options we're going to examine is a patent on a drug, right? And I can show you it looks like an option. Then I get ready to apply an option pricing model. Here's the catch. I can't trade the patent. It's owned by Merck, it's owned by Pfizer. I can't trade the underlying drug. It's not like I can go to Bloomberg and say, sell me 1 million units of this and at a fixed price. I can't trade the underlying asset. I can't trade the option. I'm applying an option pricing model that assumes replication. I can come up with a value, but I'm going to be a lot more queasy about what that value is telling me with a real option where I can't trade the underlying asset than I can with a listed option on a traded asset. So keep that caveat in mind. The real options that are easiest to value are those real options that at least have a shot of trading the underlying asset and trading the option. There are a couple where that fits, but most real options, that's the problem I run into. In fact, there are many practitioners. I mean, the problem with real options is it's filled with purists who believe real options are the answers to everything. Okay? In fact, they remind me of what Charlie Munger once said. He said, if the only tool you have is a hammer, after a while everything starts looking like a nail. These guys go around looking, and everywhere they see options all over the place. It's amazing. There's option there. And before you know it, they're hammering away everywhere, creating holes in your wall. Okay? If you listen to the purists in real options, they've got this all figured out. There's an option, use a binomial model. Why binomial models? Because there's early exercise in options. Binomial models are better. They're absolutely right from a technical standpoint. The only problem with using a binomial model is when I drew the model, I needed to specify the prices at every stage, right? You try doing that with a real option, and you're very quickly going to recognize that while in theory a binomial model is better for pricing real options, in practice actually populating that binomial tree is a nightmare. I'm actually going to use a Black-Scholes model for every one of these real options. And in my book, I actually have the binomial values of these models as well, because there's a way in which you can create a kind of binomial tree. And the values are so close that I'm not even going to bother showing you the binomial model valuations, because most of the time you're debating about should the value be 965 or 961 million. And what we should really be debating is should we even be talking about an option pricing model in this context rather than 961 versus 9. It takes the debate away from the issues that matter to the details that don't. In fact, if I can get away with it, I would actually prefer not to even use options to kind of illustrate this. And there's actually a simpler way. You can bring in everything we do in real options without ever using the word options. I mean, have you seen decision trees in one of your classes? You know how decision trees work, right? We establish all the possible scenarios and probabilities around each. If you take a decision tree and you allow discount rates to vary at each stage in the tree. In other words, when we think about discount rates, we think about betas. I mean, let's face it, depending on where you are in the tree, the risk you face can be different. If you actually adjust discount rates through a tree, you can actually show that the value you get from a traditional decision tree is exactly the same value you get from an option pricing model. So you can take managers and say, I don't get this option pricing stuff, and show them with decision trees and probabilities exactly where the value is coming from. So whenever I talk about real options, my first question to myself is, do I even need to bring real options into this debate, or is there a simpler, more intuitive way that I can use it? Because let's face it, a lot of people use real options to intimidate. You take managers who might not, it's not even that they don't have a finance background. They have a traditional finance background. They've done capital budgeting, NPV. You hit them on the head with real options. They don't know what to say, because if they say they have no idea what you're talking about, they reveal their ignorance. So you kind of bulldoze right through them, say, it's okay, expand into China, lose 5 billion. You have a real option there. So okay. They lose 5 billion, so what did we do? Okay. So real options are often used as an intimidation tactic. If you want to use it in your arsenal on somebody you don't like, feel free to use it. Throw vegas, deltas, gammas, thetas all over the place. The guy will have no idea what hit him. Move on, right? But then get back to logic and intuition with the people who actually matter. So here are the 3 tests we're going to apply with all real options. First, we're going to start off, is there an option embedded in this action? When should we be talking about options? Second, we're going to ask, is there exclusivity? Is this the only game in town? And third, is it okay to use an option pricing model? And there we're going to look, is the underlying asset traded? Is the option traded? Can I create the replicating portfolio? Is arbitrage feasible? So now that we've established that foundation, that's all the option pricing I need to kind of grapple with. Let's talk about applying this technology. We're going to talk about 3 types of options. And actually, those of you in my corporate finance class, we already laid the foundations for this at the end of the investment analysis section. But here are the 3 options. First is the option to delay. There are investments you might look at today and you say, that's a terrible investment. But I'm going to argue that there are investments that could be terrible investments today, but the right to that investment could be worth a lot, because that investment might be worth a lot in the future. So you can have an investment that's not viable, a technology that's not viable today could become viable in the future. We're going to start with that. We're going to apply that option to value patents and natural resources. So you can have a non-viable patent or an oil reserve that's not viable, but those can still have value. Second set of options we're going to talk about are the options to expand. And this is the option that really excites these people who are real options people, because this is what allows you to go into a market knowing you're going to lose money and kind of say, it doesn't matter. Especially in India and China, this is the modus operandi. You know you're going to lose money, but you know how you justify it. It's a big market. Then you throw 1 billion people into the mix. So essentially you're saying, it's okay if I lose money because there is option to expand to this huge market. Think of all the money I could make, so it's okay. So we come and take a look at the option to expand. The third option I want to talk about is the option to abandon, which is really the option to walk away from a mistake. Being able to cut your losses early is worth something in valuation, so somehow you've got to add that premium on. All of these options are on top of traditional capital budgeting. So what we're going to do is we're going to start with traditional discount. This is not an alternative to discounted cash flow valuation. It's an add-on to discounted cash flow valuation. So you take the discounted cash flow and you're going to build on top of that. So let's start with the option to delay. The basic premise of the option to delay is we're separating two issues. The first is this investment a good investment today? To answer that question, we go back to traditional capital budgeting, right? Look at the cash flows, you take the present value, you got a net present value. If it's negative, it's a bad investment. If it's positive, it's a good investment. But here's the second layer. You can have an investment that's a bad investment, but the rights to this investment, the exclusive rights to this investment, can be worth some money, because this investment, even though it doesn't make sense today, could become a good investment in the future. Why? Because things change. Cash flows change, expectations change, technology changes, costs change. So your negative net present value could become positive in the future. As I promised earlier, every option that I'm going to talk about, I'm going to frame in terms of the payoff diagram. Here's the payoff diagram on the option to delay. In fact, I'm going to use this particular payoff diagram to bring in both patents and natural resources. The payoff diagram for the option to delay, the equivalent of the strike price becomes the investment you have to make to take the project. Remember, you have the rights to the project. You haven't taken it yet. You can take it any time in the next 10 years. So what you have to invest to take the project becomes the strike price. You will do it only if the present value of the cash flows that you think you can make on this project exceed that cost. That's not true today, but it could be true 2 years from now, 5 years from now. And if that happens, you take the project to make the difference. But could you buy the rights to a bad project and the project stays bad for the next 10 years? Sure, right? It can happen. In which case, what do you lose? Whatever you paid for those rights becomes what you paid. So there's your option. The underlying asset is the project that emerges from the right, and where the contingent payoff is, will the cash flows exceed my initial investment? So let's use that to talk about patents. Right? Here's why I think patents fit the option technology. You're a company. You've essentially just got a patent. In the US, patents run, 17 years? So basically, right now, you filed with the patent agency, said you've got the exclusive rights to produce this product you've patented for the next 17 years. Let's assume that the cost of developing this patent is $100 million, 500 million. So that's what it will cost you to take this patent and make it into a commercial product. And V is the present value of the cash flows you see today, based on what you know today, of what you will make if you develop the patent. So as a company, this is the decision you face. If V is greater than I, the present value of the cash flows exceeds the cost of developing the patent, you're going to develop the patent, make the difference. If that is not true right now, then you're going to sit and wait and hope that something good happens, right? And if you think in terms of a payoff diagram, the cost of developing the patent becomes a strike price. The product that emerges from the patent, the cash flows from it, becomes the equivalent of the underlying asset. You will develop the patent and make the difference if the cash flows exceed the cost. Of course, that might never happen, in which case you lose whatever you spend getting the patent. And what was that? How do most companies get patents? R&D. You know what R&D is? R&D is the price we pay to buy options, which actually changes the way we think about R&D, right? If you're a pharmaceutical company and saying, where should I direct our R&D? If we think of R&D as the price we pay to get options, and options become more valuable the less you know about a business, the more uncertainty you have. You know what that's telling you about where you should direct R&D, right? Should you direct it at a better flu medicine or gene therapy? Flu medicine, in fact, you might say, hey, that's a predictable business. The odds are better that I'll actually come up with a product. Gene therapy, you might know very little about, but if you think in terms of options, the value of the option increases as the uncertainty increases. You can already see that R&D is going to get directed to the areas where there's the most uncertainty and away from the areas where there's the least. Other things remaining equal. So that's really the framework we're going to bring to the table. Okay? So if we decide to take this next step, we've decided there's an option, we decide there's exclusivity coming from the fact that you have the legal patent, then we have to start coming up with the inputs to the option pricing model. So let's think about actually the mechanics of the inputs we would need to value a patent as an option. First input, I need a value for the underlying asset here, right? Which is basically the question I'm asking you is, if you develop this patent today, what will your expected cash flows be? What's present value? This is like doing traditional capital budgeting, right? You're going to sit there, project out the revenues, project out the expenses, project out the cash flows, take a present value. This is an option pricing. This is traditional present value of the cash flows. That's going to become the value of the underlying asset. So that's yes. Based on what you know today. I'm not asking you to do the unknowable. Given what you know about the market and the product today, what is the present value of the cash flows? Variance in the value of those cash flows. Now we're on difficult territory. Now, up till now, if I ask you to look up the variance of something, you ran to Bloomberg, you typed in the name of the company, you got a standard deviation, right? Try this with a patent. Run to Bloomberg, type in Abonex, give me the standard deviation. And look, no, it's not traded. We can't give you a standard deviation. So here are a couple of ways in which you can estimate this variance, because you need a variance to do an option pricing model. One is you can go downstairs to the lab and try crystal ball, right? Because then you don't enter one number, you enter a distribution. You get a distribution of present values and a standard deviation. Garbage in, garbage out. So if you get strange numbers, it's your own fault. If you're lazy, here's a second thing you could try. You could look for publicly traded companies in exactly the same business. Remember how we got bottom-up betas? You can come up with bottom-up variances. You're a biotechnology company. This is the variance of biotechnology companies. I'm going to use that as a variance of the project. There's a danger here because companies are portfolios of projects. You want a variance in a project, but it's easy. You can get the number. But that's going to be a second input. For the strike price and the option, the question I'm asking you is, if you develop this patent today, what would it cost you to develop the patent? Which means manufacturing facilities, support staff, whatever you need to invest up front to get the product going. Life of the option, how long do you get this right? You got the patent, it's for 17 years. Right now, there's 17 years left. Next year, there'll be 16. Year after, there'll be 15. So don't keep the 17 fixed as you go through time. It will shrink over time. And here's the last fact. With listed options, and you've probably seen this, even if you haven't taken futures and options, even in foundations, you buy a call option thinking the stock price will go up. Let's say the stock price does go up. You have 3 months left in the option. You made the right bet, right? Your stock price went up. You have two choices. You can exercise the option and claim the difference. But what's a more optimal choice usually? Rather than exercise the option, what should you usually do? You should sell it, right? With listed options, it's almost never optimal to exercise early because you can always make more by selling the option. So if I let this option run its course, treat it like a listed option, you know what you're going to do, right? You have 17 years left on the option. When will you exercise the option? On the last day of the 17th year, you're going to wake up and say, oh my God, 3 minutes left on the option. Let me exercise. But what's the point? You've used up your protection. So you know what I'm going to do, and this is going to be a constant theme with every real option, is I'm going to introduce something to force you to exercise early. In other words, once this product becomes viable, I want to create a cost to waiting. Do you see why I need to do that? Because if there's no cost to waiting, it always makes sense to wait the extra year. So here's the cost I'm going to introduce to waiting. Let's suppose you have a drug patent. You have 16 years to expiration. The drug has become viable. Present value of the cash flows exceeds the cost. Part of you says, let's wait. We can find out more. We can collect more information. But if you do wait, do you see what you're giving up? You're giving up 1 year of protection where you could have been the only company. So basically, out of the 16 years, you're giving up 1 out of the 16 years. The cost of delay here, and this is a very simplistic way of doing it, is 1 over the remaining life. So if you have 16 years left and you wait, I'm saying you're giving up 1/16 of your protection. Next year, that's going to become 1/15, 1/14. Each year, the cost of delay is going to go up. and at some point it's going to flip you. And I'm going to show it with real numbers. When that happens, you will actually exercise the option, develop the drug, and produce the product. So let's go from abstractions to real numbers. I'm actually going to value a drug called Avonex. This drug's now well in production. It's a blockbuster drug for Biogen. I did this valuation in 1997. The reason I've kind of stayed with this example is that it's actually very difficult to get the numbers to value a drug, because one of the numbers you need is the present value of cash flows you would get if you developed the drug today. I don't know enough about this business to do that. The reason I've stuck with this example is here I got lucky. In 1997, when Biogen got the patent on Avonex, and they had 17 years left, they also released a set of cash flows through one of the investment banks as to what they thought this drug would produce in cash flows for the company. Have you ever seen cash flow projections by pharmaceutical companies? It's actually a very morbid exercise. This is actually a drug to treat MS. So here's what they do. They start off with the percentage of the population that has MS, which they roughly know. Then they look at the percentage of those people who actually go to a doctor, which is not 100%. Then they look at the percentage of people who go to a doctor who get the right diagnosis, which is not 100% either. It's actually so much below 100, it's kind of scary. Then it looks at the percentage of those people who've been diagnosed with MS who get the drug as a prescription, which is not 100% either. And then it looks at the percentage of those people who stay on the drug through their disease, which is not 100% either. And they have very good statistics going back in time because they've been doing this for 60, 70, 80 years. So Biogen had done all the projections, cash flows. And the present value of the cash flows they'd come up with based on developing the drug immediately, this is in 1997, was $3.422 billion. So that's a traditional capital budget. They also estimated it would cost them $2.875 billion to develop the drug. That's a mind-boggling number, right? You know why it was so high? Biogen had never produced and sold a drug on their own up to Avonex. They had actually licensed, most small biotechnology companies, because they don't have the infrastructure, license their drugs out. They were actually going to develop the infrastructure to develop this and sell the drug. So the $2.875 billion, you got to get a sales staff, you got all the promotional stuff, all the stuff you need to do it yourself. $2.875 billion. If I stop there and asked you for the net present value for this project, this goes back to capital budgeting 101. What's the net present value of this project? $3.422 billion is what you think you can make as present values of cash flows today, minus the $2.875 billion, which gives you $547 million. File that away. That's the discounted cash flow value of this drug. But they haven't developed it yet, right? They have the option to develop it, but they haven't developed it. So I filled in the rest of the details. I said they have 17 years of life left. Riskless rate then was 6.7% based on a 17-year life. You have to match the riskless rate of the life of the option. I used the industry average variance of small biotech companies that had no products out there. Basically, I was trying to get as close as I could to a single project variance, 0.224. Is this a viable drug right now? Yeah, present value of the cash flows exceeds the cost, so I have to introduce a cost here, which is if you do not develop this drug, what will you lose? You will lose 1 out of the 17 years of protection, which works out, that goes in where the dividend yield would go in an option pricing model. That's why I built up the Black-Scholes with the dividend yield. I'm going to put in the 5.89%. So I plug the numbers in, basically D1, D2, N of D1, N of D2. That's a traditional Black-Scholes. You work through the numbers. The value that I get for Avonex, valued as an option, is $907 million. Take a look at that number. What was the net present value? 547. This is why people love options. I've just added a $360 million premium to the value because there's an option. Will that value change next year? Even if nothing, even if the S and the K remain fixed, you know why it's going to change? The remaining life on the option will change, and the cost of delay next year is going to be what? There'll be 16 years left, 1/16th, 1/15th. In fact, I held everything else constant to see at what point. I mean, basically, this analysis says the value of this drug is $907 million, and two, don't develop the drug yet, right? Because the minute you develop the drug, what happens to its value? It goes to net present value, which if you have MS is bad news, right? Basically, you're sitting there saying, how come this drug is not coming out? We can wait. In fact, if I carry this through, and I track the values, this is holding S and K fixed. If I changed, go from 17, 16, 15, 14, the value of the option, because the cost of delay climbs, drops below the value of the exercise at t equal to 8. In other words, if I did nothing, if these numbers were right, Biogen would not develop Avonex till 8.5 years from now. This is terrible news if you have MS. I have some good news. They actually developed the drug almost instantaneously. So what is it in my analysis that I mean, based on the analysis, they shouldn't have developed the drug, right? What is it in my analysis that is wrong, that's leading me to this conclusion of they won't develop radius? Yeah?
Initially, the cost of delay because you don't consider the perpetuity.
It's not just the perpetuity. What do I assume here? For 17 years, I'm the only game in town, right? Is that true, though? What does a patent give you the right to do? To develop this drug for MS for the next 17 years. It doesn't say you're the only person working on MS drugs. What if I told you that Upjohn has a drug to treat MS that's working its way through the pipeline that's going to hit in 4 years? What's your cost of delay then? You really have 4 years of protection. Your cost of delay is 1/4. You plug in 1/4. You know what's going to happen to the value of your option? It's going to completely dissipate. I'll tell you something. When I wrote my first book on valuation, I was much more starry-eyed about patents being treated as options than I am now. Having observed how pharmaceutical companies have behaved over the last 15 years, I am convinced that the optionality in at least drug patents is vastly overstated. The optionality actually applies more if you have a non-viable drug. Because once a drug becomes viable, because competition is so intense across companies to treat the same diseases, that your cost of delay becomes so high that you're in a sense forced to exercise almost as you become viable. Right? But that's, I think, the flaw here is we're acting like we have complete, we talked about exclusivity. We say legal protection against competition. I have exclusivity, but it's not that complete, right? Because it depends on who else is working in this sphere and what they're working on. Anthony?
I was just trying to understand the expenses. When you capitalized last year, the research that went into leading up to that patent isn't included in the cost.
This is all incremental, forward-looking cash flows. So this is traditional capital budget, right? Incremental, forward-looking cash flows. The R&D you've already spent is being spent. It's a sunk cost.
Even though that in essence created the patent.
Yeah. So you could have spent billions. It's kind of irrelevant. If it's not a viable drug, it's not a viable drug, right? You can't make up for past mistakes. So in a sense, the traditional definition of sunk cost will apply. This is all forward-looking. Any other questions? Now, if you think about, yeah, go ahead.
So let's say you have Pfizer, and Pfizer is 4 months down some technology or some new drug.
It's always, there's probably 15 drugs working their way through the pipeline.
The sales estimate that we need 3% growth per year probably.
That's you're making, what they're making, or no?
Assuming that.
No, but this is not like a traditional sales, right? You have a drug, it's for a particular disease. You can't go around marketing to the general population. So when you have a drug, it already comes with a potential market labeled on it, right? You have an MS drug, you're not going to be giving it to somebody with cancer. So it's not as, I mean, pharmaceutical companies, when they project the cash flows are pretty well done. I mean, there's not a whole lot of uncertainty about the potential market. There might be uncertainty about the pricing they can charge, given what insurance companies will pay. But the market itself is fairly well defined. So you're not sitting there using a perpetual growth model and doing things which you would do in a conventional valuation, because it's a finite project.
What I'm trying to understand is how do you distinguish between the DCF value of a company and the option value?
You don't. The DCF value is an input into the option value. Well, it's not as if the DCF value the DCF value was a starting point for the option value, right? So you don't distinguish between it. The DCF value is your base. The option value comes from the fact that you haven't taken the investment yet, and the DCF value could become a much higher number. You're waiting for the DCF value to explode out so that you can lock in that value and get the higher value. So don't think of them as separate estimates, right?
That's assuming that the entire company's valuation is based on one option.
No. This is just for this. I haven't said this is the value of Biogen as a company. This is the value of Avonex as a drug. In fact, if you think about valuing an entire company, it will have 3 layers to it. There'll be the value of the existing products that have already been developed. Those are not options. Pfizer's existing products, that are traditional cash flows. So that's a DCF valuation. The second layer are going to be patents that they've just filed which they haven't developed yet. Things like Avanex, they have a patent they haven't developed, those are options. But there's a third layer that's a nightmare. Pfizer's R&D department is not shut down yet, right? They're going to continue to work. You know why that's a nightmare? I have to estimate new patents that might emerge in the future and the value that will be created by new patents and new drugs. And that's going to be difficult because I don't even know what's working its way. So this is even before they file for a patent or put it in the FDA approval process, they have drugs working through. The value of a drug company or a technology company has the three layers. First layer is existing products, DCF value. Second layer is options. The third layer is going to be your estimate of the continuing value added by the R&D department. And you might have three different levels of risk on the three different discount rates on the three. If you do this, though, don't double count. You know what I mean by double counting? I've seen people value pharmaceutical companies using conventional DCF value. Let's take Biogen. They'll use a conventional DCF value, use a very high growth rate to get the projected cash flows, using as justification that they have Avanex coming through. So they come up with a value. After they come up with a value, they'll add a premium on top. So what are you doing that for? Well, that's a real option premium because they have Avanex as an option. You can't have your cake and eat it too. If you want to count Avanex as an option, when you do your DCF valuation, you've got to do your DCF valuation without Avanex, kind of pushing up growth and cash flows because it's going to be valued separately. So let's try this. Okay? For Biogen, actually, as I said, there are two other products that they had that had already been licensed out. They didn't produce them, but they licensed them out. And the licensing arrangements they had were fairly stable ones. In fact, the licenses, I think one was to Merck and one was to Pfizer. And they were getting fixed license fees from the licensing agreement. That's going to be significant. It wasn't tied to how much Pfizer and Merck made as revenues on these drugs. It was a fixed fee. As I said, those are traditional cash flows, and we have to take the present value of the cash flows. At what rate, though? What discount rate should I use? What's the risk of these cash flows? They're guaranteed by Merck or Pfizer, right? So under what conditions will they not be delivered? The companies go bankrupt, right? You know what I used as my discount rate for these cash flows? I used the cost of debt of Merck and Pfizer as my discount rate. Not the cost of debt of Biogen. It's not even a player in the game. It's the cost of debt of Merck and Pfizer because it's the default risk that I'm worried about. That present value is $397 million. The collective license fee was $50 million, but because it was a fixed license fee and the only risk I had was default risk, I brought it through the cost of debt. Let me ask you a question. If this license had been framed differently, a percentage of revenues, then would I have still used the cost of debt? No, then there's uncertainty. Then you'd have talked about a cost of capital based on the fact that it's a developed drug, which might have been 10%, 11%, 12%. It's because it was a fixed license that I used the pre-tax cost of debt. So I've got the first layer nailed down, $397 million. I've got the second layer nailed down. The only patent they had was the Avanex patent and a value of $907 million on it. So I tried my hand at the third layer. And here I had to make some estimates. Biogen is a continuing R&D department. I made a couple of assumptions. First, I assumed, I took the R&D expense from the most recent year that I pulled off the income statement and assumed those R&D expenses would grow 20% a year, which was a pattern they'd been showing for the next 10 years. That was the easy part. I also assumed that $1 spent in R&D would generate $1.25 in value. I based it actually on the return on capital and cost of capital across biotechnology companies. Basically, I'm assuming that this is a value-added proposition. And you're going to see in a minute, if I'd set it at $1, what's going to happen to the value. But that's where the value added comes from. They invest $1, they get back $1.25. After year 10, I assume that the excess returns go to 0. For the same reason we did it in traditional DC evaluation. Finally, I have a huge amount of uncertainty about this component of value, so I'm going to use a much higher cost of capital, much higher discount rate of 15%. So here's all I did. I took the R&D costs every year, that's a 20% growth every year, multiplied it by $1.25 gives me the value that I create every year. The difference between the two is the additional value I create. Discounted back to today, the present value is $318 million. Nothing after year 10, because after year 10 I have 0 excess returns. Now if I'd assume that $1 in R&D cost creates $1 in value, then this component goes towards 0. I'm assuming there's value added by R&D, and that's going to be the third layer of value. My combined value for Biogen will be $397 million, that's the present value of the licenses, $907 million, which is the value of Avanex as a option, 318 million, which is the value of the R&D department on a continuing basis. The sum of those values, 1.622 billion, is my estimate of Biogen's operating assets. To that I would add cash, subtract out debt, divide by the number of shares, do everything we did in traditional valuation, but it's an alternative to conventional DCF valuation. This layer, which of the three layers, the layer that obviously is going to give you the most trouble is that third layer, the R&D layer. Thanks. But that's a layer we have to deal with. I mean, let's face it, there are some pharmaceutical companies that are more efficient about R&D and others that are not. That's the place you're going to reward them. So let's pass real option through the test. Is there an option? Obviously. You can draw the payoff diagram. There's obviously an option in a patent. Is there exclusivity? Partially, right? We have exclusivity because you have legal protection against competition, but that doesn't mean you won't get any competition at all. It could come from other people working in the same drug. Can I apply option pricing models to value this? Now I'm in dangerous ground because neither the option nor the underlying asset is tradable. So when I come up with a $907 million value for Avonex, if you said, how are you going to monetize that value? I said, I'll try. I'll try to sell it to Merck for $907 million, but if they pay me $650, I'm going to take it because that's the best I can do. So I think that there is value to applying real options with technology and patents, but don't get carried away. Okay? Because you don't have this complete exclusivity, it's going to be very difficult for you to monetize the value. You're going to very quickly start to see value disappear. So I think it's more relevant, as I mentioned earlier, to value non-viable options, non-viable patents. So if somebody comes in and says, I have a drug to treat AIDS, but it's not viable today because the technology needed to create it is so expensive, and you or Merck pay for it because it's, even though it's not viable today, having the exclusive rights to this drug for the next 12 years might allow you to make money somewhere along the way. Yes, ma'am?
So is there an argument for putting a liquidity discount, I guess?
You could. Basically, it could be some kind of discount, right? Because it's not an arbitrage. You could apply a liquidity discount after you value the options. How much you discount will depend on how tradable any of these pieces are. Yeah. Any questions on patents? Yes?
What did you use pre-tax cost of debt in the existing product?
Why did I use the pre-tax cost of debt as opposed to what?
Cost of capital.
Because the risk, the cost of capital reflects operating risk, right? These are fixed licenses, right? I mean, in a sense, let me change the question. Let's suppose that these licenses have been given to the government. The government had guaranteed $50 million every year. Then what would you use? You'd use the risk-free rate, right? So don't get too caught up in cost of capital as your tool for all trades. It really depends on the uncertainty of the cash flows. You can have safe cash flows, risky cash flows coming from the same entity. You have to look at what the terms of the agreement are. Okay? If the license had been specified differently as a proportion of revenues, proportion of income, then I think it makes sense to talk about the cost of capital as your discount rate. Let's stop there. We'll start back up with the natural resource options in the next class. Actually, we'll start with this after the quiz. The quiz will not, in fact, a couple of things. The quiz will cover only packet 2. Oh, you said, if I'd known that, I wouldn't have listened today. Right? I know, that's why I didn't mention at the start. It'll cover only packet 2. In terms of the chapters in the book, it's chapters 17, 18, 19, 20. 18 is earnings multiples, 19 is book value multiples, 20 is revenue multiples, 17 is kind of the first, and then the private company valuation chapter, which I think is 23. Right? So it's those 5 chapters.